Good morning, it's February 9th, and today we're going to go over a few ideas in the options market, but then also looking at the Longbow dashboard to see how you might keep track of things before potentially deciding on an execution. UBS put some really great stats out this morning. As of the beginning of February, the estimated short interest of stocks in key US indexes was low versus the prior 3 years. So for the S&P, it was at the 11th percentile. For the Russell, 14th percentile, and then the NASDAQ, 20th percentile. And in mid-January, if you look at ETFs representing those stocks and the big indexes, the short interest was low already versus prior 3-year levels. For the SPY, it was the 10th percentile, IWM, so that's for, complement to the Russell, 8th percentile, and then the Qs, complement to the NASDAQ, 14th percentile. Also, you've got stock option put call ratios remaining really low as well. 7th percentile versus 3-year levels for stocks in the S&P and NASDAQ 100's top 25 stocks. So the Qs seem to be the most under hedge. What can you do? Using options, you could do a put spread, so funding a slightly out of the money put by selling a further out of the money put, or execute a bear collar by selling an upside call. And right now, put spread premiums are not that costly. They're at the 40th, 50th percentile versus 5-year levels. And bear collars are even cheaper at the 10th to 30th percentiles versus 5-year levels. A bear collar on the Qs is a premium at the 7th to 15th percentile versus 5 years. It can capture the potential reversal of the recent short squeeze we've seen. And so, for example, if people were short tech, they covered that. And we've seen kind of a massive rally in tech with disinflation number coming out and like. So those 3 different securities we looked at here can be found on the macro ETFs tab of Longbow. So I ordered them here for the SPY, the Q, and the IWM, the Russell here at the top. And as you can see, the white bar is in the middle of the green and the red. So it wouldn't be quite there yet for the overbought level. So ideally, if you were looking to execute or think about it, even just with like a pure short or putting on hedges like we were talking about before, ideally, you'd see it at the top end of the range, but this is a great place you can look without using those tickers on your own tab, your own individualized tabs like I have up here. You can just get the macro ETFs tab and keep a look on those. But let's look at the Qs because those look to be some of the most reasonable. Again, here we're at 307. We're saying, you've got, call it 10 more bucks before you would be in an overbought level. And then it could drop all the way down to 287. So that's a pretty big fall. Although you've got more short interest right now showing up right here, and it is in a bullish formation, short term and medium term. But if you're in the camp, as many people are right now, that there's a real disconnect between what the Fed is saying, which is higher for longer, as well as the strong labor market. Obviously, if rates were going to be going up above 5% to even hit the 6% level, you would probably see a reversal on all this long duration like things. So those TLTs, the Qs, all the different things that were trading off last year when rates rose, you could see that unwind again this year. We're not saying it's going to happen, but we're always looking for what's non-consensus, what might be reasonable, and how do you protect positions? So if you have tech positions, if you've bought into the rally, you can think about different ways in order to protect those positions. That's it for today, and we'll see you back tomorrow.